Hi everyone, good evening. It's Friday, October 24th, and welcome back to the US Stock GPS channel. Today, US stocks rallied across the board on cooler than expected inflation data and strong corporate earnings, extending yesterday's rebound with a clearer risk-on tone. The Dow Jones gained 1.01%. The Nasdaq Composite rose 1.15%. The S&P 500 added 0.79%, and the Russell 2000 outperformed with 1.22%, showing renewed appetite for small caps. In today's episode, we'll go over the CPI report, highlight key earnings in individual stocks, and analyze the recent surge in the solar energy sector. CPI cooling, inflation boosts market confidence. The September Consumer Price Index, released this morning by the U.S. Department of Labor, came in cooler than expected. Headline: CPI rose 0.3% month over month, below the 0.4% expected and last month's 0.4%. Core CPI rose 0.3% matching both forecasts and last month's pace. On a year-over-year basis, headline inflation ticked up to 2.9%, still below expectations of 3.1%. Core CPI was up 3% versus 3.1% expected, and down from 3.1% previously. Markets interpreted this cooler inflation report as a positive surprise, reinforcing expectations that the Federal Reserve will cut rates by 25 basis points at both the upcoming and December meetings. That optimism helped drive today's broad-based rally. Ford strong core business, effective guidance upgrade. Ford reported Q3 results after Thursday's close, and both EPS and revenue smashed Wall Street estimates, thanks to strong performance in its traditional fuel vehicle and commercial fleet divisions. The commercial segment alone contributed nearly $2 billion in EBIT profit, underscoring the company's earnings power and stability. Its EV division widened losses to $1.4 billion amid high investment and tough competition. The company lowered full-year guidance, not because of weak results, but due to a fire at supplier Novelis's aluminum plant, disrupting key materials for F-Series pickup trucks and SUVs. Adjusted 2025 EBIT was revised down to $6.5 billion. The stock initially dropped after hours, then quickly rebounded as investors focused on the strength of the core business and management's optimism about restoring supply. Ford's EPS of $0.45 and revenue of $50.5 billion both beat expectations. Analysts emphasized that excluding the $1.5 billion EBIT loss from the Novelis fire, Ford would have raised guidance, essentially an effective guidance upgrade. Investors rewarded that operational efficiency. Ford also announced a pause in F-150 Lightning EV production to focus resources on high-demand fuel and hybrid F-150 models, a pragmatic shift welcomed by investors in today's weak EV market. The stock closed up 12.16%. Traders may accumulate gradually on dips or small pullbacks. Intel earnings beat, but intraday profit-taking. Intel delivered strong Q3 results, signaling real progress in its turnaround strategy. PC revenue, $8.5 billion, plus 5% Y, driven by seasonal demand and new Lunar Lake and Arrow Lake chips. Non-GAAP EPS turned to a profit of $0.23 versus a loss of $0.46 a year ago, far above the $0.02 consensus. Gross margin jumped from 18% to 40%, showing successful cost control and product mix improvement. Intel also strengthened its balance sheet by selling partial stakes in Altera and Mobileye and securing fresh funding from the US government, NVIDIA, and SoftBank. Management expects demand for computing capacity to outstrip supply through 2026, a positive signal for AI-related growth. Despite the strong report, the stock opened 7% higher, but faded through the day as short-term traders took profits after a 40% run since September. Analysts also noted that Intel's gross margin, 47.2%, remains below peers like AMD and TSMC, leading some funds to rotate elsewhere. The stock closed up just 0.31%. Technical plan: wait for a pullback to support, stabilization, and a close above the previous day's high before entering or add on a strong volume rebreakout. Comfort Systems USA is a large U.S. mechanical, electrical, and plumbing services contractor providing HVAC installation, electrical systems, and building maintenance for commercial and industrial clients. It operates nationwide with both construction and service divisions. Fix is a stable, profitable, and moderately growing industrial service provider with high ROIC and low leverage. Comfort Systems USA, blowout quarter, and power breakout. Fix reported record-breaking Q3 results with soaring demand for mechanical and electrical contracting services. Revenue jumped 35%, GAAP EPS $8.25, nearly doubled from $4.09 a year ago. And operating margin expanded from 11.2% to 15.5%. Backlog reached $9.38 billion, up 65% year over year, providing outstanding visibility for future growth. Operating cash flow of $553 million, more than doubled from last year. The company also raised its dividend and announced 2 acquisitions. Fix shares soared 18.99%, hitting new highs. Technically, after such a vertical move, the stock often consolidates for 3 to 6 sessions. Best approach: wait for a pullback and stabilization, then enter when it closes above the previous day's high, or add on a strong volume break above $1,000 if momentum continues. Solar sector AI-driven power demand revives clean energy stocks. The solar sector has been one of the top performers across daily, weekly, and monthly timeframes. ETF TAN has soared over 80% since April. Under President Trump's fossil fuel-focused energy agenda, renewable subsidies were cut and many green policies rolled back, causing solar stocks to plunge through early May. But the turning point came after May 12, when news emerged that tax credits for U.S. domestic solar manufacturers, especially for First Solar, would remain partly intact. The less bad than feared outcome sparked a massive short covering rally, with First Solar up 35% in 2 days and lifting the whole sector. Although the final bill still reduced many renewable tax credits, solar stocks kept rising as a new structural theme emerged: AI-driven energy demand. AI and large-scale data centers are creating unprecedented stress on U.S. power grids. A single AI campus can consume several gigawatts of power. To meet that massive and often clean power requirement, solar energy is now the most scalable and cost-effective solution. Solar costs have fallen nearly 90% over the past decade, making it cheaper than fossil fuels in many regions. Solar and storage combinations are now the core of new U.S. power infrastructure growth. Investors see solar as a long-term beneficiary of the AI revolution because it addresses the future energy bottleneck. Recent Treasury guidance on clean energy credits was also less restrictive than feared, especially for small-scale rooftop projects. Top solar leaders to watch. 1. First Solar, a vertically integrated thin-film solar module maker with one of the strongest balance sheets in the industry, usually net cash positive. Its huge utility-scale backlog provides multi-year visibility, and its U.S.-made modules benefit directly from advanced manufacturing tax credits. Its unique thin-film technology performs better in hot and low-light conditions. The stock has doubled since April. Consider buying after a healthy pullback and rebound with volume. 2. Rio, Nextracker, the global leader in utility-scale solar trackers that enable panels to follow the sun for higher efficiency. Nearly every large-scale solar plant uses its trackers. The company just reported another earnings beat and raised full-year guidance. With surging AI data center power needs, Nextracker is positioned to benefit directly as a key supplier to utility-scale projects. The stock rose 8.74% today. You can accumulate on stabilization and breakouts in stages. Wrap up. U.S. markets ended the week strongly, led by industrial and tech sectors. Optimistic earnings and declining yields reignited risk appetite. Though short-term technical indicators look a bit overheated, a modest consolidation early next week would be healthy. Thanks for watching, friends. If you found this video helpful, please remember to subscribe, like, and share. See you next time.